Welcome to the quarterly briefing for ICMA members. Before we begin, I'd like to mention a few housekeeping points. This event will feature a 1-hour presentation from ICMA's Market Practice and Regulatory Policy team. Delegates are on listen mode only, and only speaker videos will be shown. Should you have any questions you wish to raise, please send them to questions@icmagroup.org, and we will respond to them bilaterally after the webinar. A recording of this webinar will be made available to all members, and over the next few days, we'll send an email with the relevant links. I will now hand over to Martin Scheck, ICMA's Chief Executive, for his introductory remarks.
Good day to you all. My name is Martin Scheck, and I'm the Chief Executive of ICMA, and it's my pleasure to welcome you all to today's presentation of our most recent quarterly report. And I'm pleased to make a few introductory comments. Our AGM this year was again a written affair as a result of the impact of the pandemic, and it took place on the 24th of June. So a warm welcome to two new board members voted in by our members, Virginia Laird from Citigroup and Per Åke Nyberg from Swedbank. We are planning for a return to a full-scale physical AGM and conference next June in Vienna. Let's all hope this will be possible. By embracing new technology and developing different skills and techniques, ICMA has coped well with the pandemic. We have been able to remain efficient and effective during the remote working period. But now that the restrictions are easing, we are hopeful that towards the end of the summer, we can again use our offices more normally with a resumption of social contact and face-to-face meetings. This quarter report is packed with information on our many initiatives and activities, and I'd just like to highlight 5 of them. Firstly, we're delighted to have opened a representative office in Brussels, to have recruited a first person to work in that office. Following the end of the post-Brexit transition period, it's clear that we need to continue to engage separately and in parallel with the EU and the UK authorities. And this new office, augmenting our presence in Paris, will help support the EU work on which we've already been engaged for some time, and it reinforces our presence in the EU. Secondly, our activities in Asia, led by our Hong Kong office. This last quarter has been one of the most productive ever, and a highlight was the response we submitted to the Securities and Futures Commission in Hong Kong on the wide-ranging and globally important consultation on primary market processes. This was a complex task involving all of the constituencies involved in our primary market practices: issuers, primary underwriters, and investors. Others include a comprehensive guide to tough legacy bonds in Asia Pacific, together with Bloomberg, and a significant Asian component in the excellent report comparing sustainable finance taxonomies across jurisdictions entitled Overview and Recommendations for Sustainable Finance Taxonomies. In Japan, we provided significant input to the Japanese authorities as they created the basic guidelines on climate transition finance, which explicitly referenced our climate transition finance handbook. This led to a well-received seminar jointly hosted with the Ministry of Economy, Trade and Industry, promoting transition finance and explaining these new Japanese guidelines. And all this is in addition to the usual technical work, speaking with the authorities and with our members in China and in many other Asian countries. Thirdly, the sustainability agenda, which straddles all our activities. We continue to help nurture growth in the sustainable bond markets through our role as Secretary of the Green and Social Bond Principles, the Sustainability Bond Guidelines, and the Sustainability-Linked Bond Principles. But our involvement in sustainability also includes working with national and regional authorities in many regions and countries, amongst which the EU Platform on Sustainable Finance, the ASEAN Capital Markets Forum, the Japanese and Chinese authorities already mentioned, and a number of other advisory groups. Many regions and countries now have their own taxonomies, all at various stages of development and each subtly different. The paper I mentioned that we published compares major taxonomies and provides advice in terms of common principles for the creation of new ones. Further convergence is certainly desirable. The AGM for the Green and Social Bond Principles, held on 10th of June, and the associated conference showcased important updates to the Green Bond Principles, Social Bond Principles, and the Sustainability Bond Guidelines. We also released supporting documents with further advice and guidance, including on the KPIs referenced in the Sustainability-Linked Bond Principles. Regulation of the sector continues apace. Complex, far-reaching, and with significant implications for all our members, particularly in the context of disclosure legislation, we respond to all consultation papers which are relevant. And this will continue to be a major ongoing focus. One trend we're seeing is a desire to bring sustainability to the whole financing spectrum of an entity, including the short-term funding markets. And in this context, we published in June a paper which looks at the role of repo in sustainable finance. At this stage, asking questions and exploring views prior to formulating a position and possibly providing guidance. Fourth, the transition to risk-free rates continues to intensify as the clock counts down towards the discontinuation of LIBOR. We remain highly focused on the transition in the bond market through our work on the risk-free rate working groups of the UK, the EU, and Switzerland. Our focus now is mainly on the tough legacy issues for those LIBOR-linked bonds which are difficult to transition. The mechanics to ensure an orderly wind down of LIBOR are complex. We will continue to provide extensive technical advice, as well as ensuring that our members are kept fully updated via briefings and webinars, such as a recent panel that we moderated involving the US Federal Reserve Bank of New York, the ECB, the UK FCA, and the Swiss National Bank. The last point relates to fintech, and we're coming to the end of the first phase of an initiative to augment the product scope of the common domain model, the CDM, by adding repo and collateral trades and cash bonds. This initiative translates these to software code working with a third-party software company, and we contribute the code to the CDM, which is a digital representation of life cycle events of financial products. We see this initiative as a building block for the digitization of the capital markets, leading to smart contracts and creating future benefits for members. My colleagues expand on these points later and on our other initiatives in the body of this quarterly report. As a final point, I want to mention that this is the last quarterly report I'll be contributing to as Chief Executive of ICMA. As you will have seen from our recent press announcement, ICMA's board has successfully concluded a process to find my successor, and I'm delighted to welcome Brian Pascoe, who will be taking over as Chief Executive on the 6th of September. It's a testament to our reputation that we're able to appoint such a senior and experienced market practitioner to this role. I've absolutely no doubt that Brian is the right person to lead ICMA through its next phase of development. I will remain with ICMA as president during a transition period, and I'm looking forward to supporting Brian. It's really been a privilege to serve the association and our members as chief executive since 2009, helping to guide ICMA through a period of immense change and expansion, and I've enjoyed it thoroughly. The transition to a new chief executive comes at a time when ICMA is particularly healthy: record membership, fabulous member engagement, strong regulatory relationships, a clearly defined strategy, and a robust financial position. But this has only been possible with the unwavering support of our members and a marvelous team of colleagues at ICMA. Thank you all.
I would now like to introduce Paul Richards to discuss the orderly wind down of LIBOR in the bond market.
The quarterly assessment in the ICMA quarterly report is about plans for the orderly wind down of LIBOR in the bond market under English law. It focuses on the wind down of LIBOR in the sterling bond market, as this is now due to take place ahead of the wind down of US dollar LIBOR. As a result, the wind down in the sterling bond market has become a test case. It's also a case in which ICMA is actively involved. Ahead of the cessation of sterling LIBOR panel bank settings at the end of 2021, the transition away from LIBOR in the sterling bond market involves three main steps. The first step has involved encouraging the use of overnight SONIA compounded in arrears instead of LIBOR for new bond issuance as soon as practicable after the original FCA announcement in July 2017 that LIBOR will cease on or after the end of 2021. In the UK, new sterling bond issues, both in the form of FRNs and securitisations, have now been referencing overnight SONIA compounded in arrears instead of LIBOR for some time. This is in line with the authority's preference for the use of overnight SONIA compounded in arrears as the most robust rate. The adoption of SONIA in new issues has also had the effect of capping the number of legacy LIBOR bonds outstanding. This number then diminishes as bonds mature and is also reduced when certain LIBOR bond fallbacks are triggered. The second step is actively to transition legacy LIBOR bonds to SONIA where this is practicable, to reduce them to an irreducible core by the end of 2021, as recommended by the authorities. Active transition in the bond market is currently in progress, where practicable. The third step is to address the remaining legacy LIBOR bonds outstanding through the authorities' proposals for tough legacy in order to ensure an orderly wind down of LIBOR in the sterling bond market. In our view, there are three main tough legacy challenges in the sterling bond market. The first is that the bond market will not be able to transition all the outstanding legacy sterling LIBOR bonds by the end of this year. Some are too difficult to convert, and there are also too many to convert in time, as around 70% of them are expected to fall back from a floating rate to a fixed rate for the remaining life of the bond at LIBOR cessation. Doing nothing about this runs the risk of market disruption. The UK authorities' proposal to address the problem through legislation will allow synthetic LIBOR to continue at a floating rate for certain tough legacy contracts when panel bank sterling LIBOR ceases at the end of 2021. Synthetic LIBOR is expected to consist of term SONIA plus a fixed credit adjustment spread. ICMA has argued that the FCA should allow all outstanding legacy bonds where fallbacks have not already been triggered to use synthetic LIBOR, not just some of them. If sterling LIBOR is available on screen, but some legacy sterling LIBOR bonds outstanding are prohibited by the FCA from using it, this could create market uncertainty and potential legal problems. ICMA responded to the FCA consultation on this on the 16th of June. The second challenge is the need to minimize market uncertainty and the risk of litigation. In particular, when sterling panel bank LIBOR ceases, it will be important to ensure that synthetic LIBOR is treated in the market as the continuation of the previous LIBOR panel bank rate. On the 7th of May, following a consultation by HM Treasury, the UK government announced that it intends to bring forward further legislation which will seek to reduce disruption that might arise from LIBOR transition with regard to the potential risk of contractual uncertainty and disputes in respect of contracts that have been unable to transition from LIBOR to another benchmark. In other words, tough legacy contracts. The third challenge is the need to ensure international alignment between different currencies and jurisdictions to support an orderly wind down of LIBOR. This does not mean that the timetable and the approach to the orderly wind down of LIBOR needs to be identical. There are some differences between currencies and jurisdictions in the timetable planned for the orderly wind down. LIBOR settings in euro and Swiss francs are due to cease permanently at the end of 2021. Japanese yen LIBOR may continue on a synthetic basis for certain legacy contracts after the end of 2021 for one further year. Synthetic sterling LIBOR is due to continue after the end of 2021 for certain legacy contracts for a maximum of 10 years, but subject to annual review. Panel bank LIBOR in US dollars is due to continue to be representative for use in legacy contracts until the 30th of June 23. And while there are plans for the replacement of Ionia by Ester by the 3rd of January 22, there are currently no plans for the discontinuation of Euribor, though robust fallback language addressing permanent cessation, temporary non-availability, and non-representativeness of Euribor has been recommended in case this is needed in future. There are also some differences in the approach to the orderly wind down in the different LIBOR currencies and jurisdictions. While the UK is proposing to address tough legacy contracts through synthetic LIBOR when panel bank LIBOR ceases, the US is proposing a different approach. The difference arises because the UK is keeping the same benchmark, LIBOR, for certain legacy transactions, but changing the methodology to be used for its composition from panel bank LIBOR to synthetic LIBOR, whereas the US is proposing to replace the LIBOR benchmark with a commercially reasonable substitute for LIBOR and a commercially substantial equivalent. It'll be important to establish whether the result is the same, given the large number of legacy dollar contracts under English law. An additional difference is that while the use of synthetic LIBOR under English law is limited to a maximum of 10 years, subject to annual review, there's no time limit on the use of the replacement benchmark under New York law. Although the timing and approach differ between LIBOR currencies and jurisdictions, the overall direction of travel away from LIBOR towards risk-free rates is much the same. And there is international coordination between the authorities through the FSB Official Sector Steering Group, chaired by Andrew Bailey as Governor of the Bank of England, and John Williams as President of the Federal Reserve Bank of New York. As a result of international coordination, global agreement has been reached by the FSB and EOSCO and was announced on the 2nd of June to stop the use of LIBOR in new transactions, including in US dollars, by the end of 2021. And while tough legacy legislation needs to be introduced and implemented at national level, the authorities have shown that they're aware of the importance of avoiding a conflict of laws between the UK, the US, and the EU. Thank you.
I will now hand over to Katie Kelly, who will cover the legacy LIBOR bonds in Asia Pacific.
Hello, I'm Katie Kelly, a Senior Director in Market Practice and Regulatory Policy at ICMA. Recently, ICMA partnered with Bloomberg on a guide to tough legacy bonds in the Asia Pacific region. Using data provided by Bloomberg, the aim of the guide is to provide the Asia Pacific market stakeholders with an overview of the risks and potential mitigants in the regional bond markets with respect to legacy bonds. The guide highlights some of the characteristics of the legacy bonds in the region, but what is significant is the universe of the total outstanding legacy issuance figures for bonds in the region. US dollar 190 billion equivalent across 560 issuances, and for securitizations, US dollar 330 billion across approximately 700 issuances. Looking at the bond issuances, of the 560 legacy issuances, 196 approximately have fallbacks which are likely to anticipate using the rate in effect for the last preceding interest period, essentially changing the bonds into fixed rate bonds for life. And 251 of the 560 have no fallbacks at all. Taken together, this figure becomes quite significant. totaling about 80% of all legacy bonds in the region. And under Japanese law, the number of bonds which contain inadequate fallbacks or no fallbacks at all is 26% of all legacy bonds in the region. The guide highlights that while market developments and market infrastructure signal excellent progress in the transition to risk-free rates in new bond issuance, there still remain pockets of the market which are over-reliant on LIBOR. In the Asia-Pacific region, issuance of new LIBOR-linked bonds has continued into 2021. And while there is recommended fallback language for US dollar LIBOR-linked bonds and for Japanese yen LIBOR-linked bonds, a material proportion of this new LIBOR-linked issuance contains no fallbacks at all. So on the permanent cessation of LIBOR, it isn't clear what will happen to this universe of bonds which have inadequate fallbacks or which have no fallbacks at all. In terms of potential solutions, there's consent solicitation, a market-based process which enables an issuer to amend bond conditions by way of bondholder consent. In the sterling market and under English law, almost 70 sterling LIBOR-linked legacy bonds have already undergone successful consent solicitation processes to transition from LIBOR to SONIA. But under New York law, amendments to interest rate provisions in bond terms typically require consent of 100% of holders of the bonds. So the process is not used much and it's not practical. And under Japanese law, although consent solicitation is possible, bondholder meetings rarely take place in Japan, and therefore convening a meeting to transition LIBOR referencing bonds is not likely to be familiar to many Japanese market participants. In terms of legislative intervention, the US is implementing a contract override of US dollar LIBOR to SOFR. In the UK supervised entities will not be permitted to use what is known as synthetic LIBOR unless they're permitted to do so by the FCA. The FCA has recently consulted on whether to permit UK supervised entities to use synthetic LIBOR. The results of that are not yet known. In the case of Japanese yen LIBOR, the FCA is currently consulting on requiring ICE Benchmark Administration, the administrator of LIBOR, to continue to publish a synthetic version of Japanese yen LIBOR after the end of 2021, but only for one additional year. So publication of this will cease permanently immediately after its final publication on 31 December 2022. The guide concludes that the outcome for these legacy bonds with inadequate or no fallbacks on the future cessation or less of unrepresentativeness of LIBOR could lead to a risk of uncertainty, market disruption, and could potentially impact market financial stability. And although some LIBOR settings may have a temporary reprieve due to the proposed legislative interventions, the legislation might not address all issues or be practicable in all circumstances and might not be available for long enough. So, in conclusion, market participants in the Asia-Pacific region should assess their LIBOR exposures and determine and establish plans to address it. Thank you.
Julia Rodkiewicz will now present the regulatory policy work in the new ICMA representative office in Brussels.
Hello, I'm Julia Rodkiewicz, a director at ICMA. I contribute to the ICMA policy work as secretary of the Regulatory Policy Committee. I have joined recently, and I'm very proud to be the part of ICMA expert team. I am the first employee in our new representative office in Brussels, and I'm going to speak today about our work in Brussels. The new office opened in May 2021. It marks an important step for ICMA. In this way, we extend our physical presence in continental Europe. This reflects our membership across the EU. Just over 40% of ICMA's members are based in the EU, including 15 EU central banks. As to the primary role of the representative office, it is to facilitate our communication with EU institutions and EU member states authorities at all levels. We will build upon ICMA already existing relationships and we will be communicating on topics affecting the international debt capital markets. We will be sharing market data and regulatory analysis. Our work is, of course, carried out in cooperation with ICMA members from all constituencies. In the short time the office has been operating, we have intensified our dialogue with the European Commission, European Parliament, and several ministries of finance. We have been engaging on several key regulatory issues. Our most recent focus has been on the CSDR mandatory buy-ins, MiFID bond market transparency. We have been also discussing the product governance regime under MiFID Quick Fix. Our recent engagement also includes work on sustainable finance via the EU platform on sustainable finance. For more detailed information on these matters, I would like to invite you to see the relevant sections of the ICMA quarterly report published last week. You will find this information in the sections dedicated to primary markets, secondary markets, and sustainable finance. We have already seen the benefits of being able to deliver our messages to policymakers in a more integrated manner. We have been highlighting links between various dossiers. For instance, we've been raising the issue of the potential adverse impact of the upcoming buy-in regime on the market liquidity. We have been stressing that it would be not in line with the objectives of the EU Capital Markets Union. This holistic approach is particularly important when we want to avoid unintended consequences or unnecessary market fragmentation generally. As mentioned before, I will be secretary of the ICMA Regulatory Policy Committee. The Regulatory Policy Committee recently held a meeting with Jean-Paul Servet, Vice Chair of IOSCO and Chairman of the Belgian Financial Services and Markets Authority. Among other topics, we've discussed international supervisory cooperation and sustainable finance developments. We look forward to developing the work of the Brussels Representative Office in collaboration with ICMA's members. We will be engaging in work streams related to primary markets, secondary markets, repo and collateral, short-term markets, sustainable finance, asset management, fintech, the transition from IBORs to risk-free rates, and other topics affecting the international debt market. These activities will, of course, be carried out in close cooperation with the other ICMA offices, which are located in Zurich, Paris, London, and Hong Kong. We will be taking into account the EU, national, and global issues arising from market practice and regulatory policy debates. I look forward to working with you. Thank you.
I will now hand over to Valérie Guillaume to provide the 2021 update of the Green and Social Bond Principles.
Hello, my name is Valérie Guillaume. I'm working at ICMA Sustainable Finance Team. I'm based in the Paris office of ICMA. I will focus my comments on the update of the 2021 edition of the Green and Social Bond Principles, published on June 10th, and will present briefly the parallel publication of other documents representing further voluntary guidance for the sustainable bond market. The Executive Committee of the Principles published the 6th version of the Green Bond Principles on June 10th, 2021. This was the first update of the GBP since 2018. Over the last 3 years, this crucial document, translated into 24 languages, has been at the center of developments in the market, and it has gone mainstream. With this 2021 edition, the GBP integrates best practices that are already recognized by the majority of issuers in the market, while also preparing for current and future regulatory developments, especially in the US, but also in Asia. The 4 core components of the GBP stay unchanged in substance. These are use of proceeds, including eligible green project categories, process for evaluation and selection, management of proceeds, and reporting. But the 2021 version now identifies two key recommendations regarding bond frameworks, where issuers describe the alignment of their green bond with the four core components of the GBP. And second, external reviews, both pre-issuance, whereby the reviewer assesses the alignment of the green bond with the four core components of the GBP, and post-issuance to verify the internal tracking and the allocation of funds from the green bond proceeds to eligible green projects. In addition, the GBP 2021 re-emphasized transparency requirements from issuers. Firstly, transparency at the organization level. GBP 2021 encouraged issuers to disclose the context of their overarching objectives and strategy related to environmental sustainability. This notably reflects the increasing investors' and stakeholders' expectation. It is indeed a growing trend for investors, especially to focus not only on use of proceeds of green bonds, but also on the issuer's overarching commitment to sustainability and climate transition. Secondly, transparency at project level. GBP 2021 encouraged the voluntary disclosure of information on the degree of alignment of project with official or market-based taxonomies. Thirdly, transparency when evaluating risks. GBP 2021 promotes transparency on issuer processes to identify mitigants to perceive or known material risk or negative social and/or environmental impacts as a form of due diligence for do no significant harm. Furthermore, where issuers wish to finance projects towards implementing a net zero emission strategy aligned with the goals of the Paris Agreement, the GBP 2021 encouraged issuers to refer to the guidance on disclosure and climate transition strategy provided in the Climate Transition Finance Handbook. We can note that the GBP 2021 also includes important references to complementary guidance from the principles, specifically the Harmonized Framework for Impact Reporting and the guidelines for external reviews. This illustrates the relevance and recognition of these documents and the importance of the overall ecosystem of interconnected guidance that is now available. Finally, the GBP 2021 also features in an annex an infographic that summarizes both the product guidance available for sustainable bonds, both use of proceeds and sustainability linked, and the thematic guidance in the Climate Transition Finance Handbook. The 2021 edition of the Social Bond Principles and Sustainability Bond Guidelines have been similarly revised. Based on the work reported by the working groups, the Executive Committee of the Principles has in parallel released a number of other important publications, notably illustrative example for the selection of key performance indicators for sustainability-linked bond issuers, underwriters, and investors, a pre-issuance checklist for social bond programs that aims to give guidance on the steps for establishing a social bond framework as recommended by the 2021 edition of the Social Bond Principles. Guidelines for impact reporting database providers that aim to increase transparency and promote best practice. They are accompanied by a mapping of database providers that inform market participants on the range of services offered, as well as the context and content of the services provided. Last but not least, suggested impact reporting metrics for circular economy or eco-efficient projects that complete the range of metrics on green project categories that are regrouped in the Harmonized Framework for Impact Reporting. Thank you very much for your attention.
Charlotte Bellamy is our next speaker, who will talk about ESG disclosure for new bond issues.
Hello, my name is Charlotte Bellamy and I'm a Senior Director in ICMA's Market Practice and Regulatory Policy team. Sustainable finance has been an unmissable and for many an exciting trend in capital markets recently. For ICMA's Legal and Documentation Committee and its ESG working group, this trend has led to detailed discussions on market practice for disclosure of environmental, social and governance, or ESG, information in prospectuses for different types of bonds. Starting with green, social and sustainability bonds, which are bonds where the issuer intends to use the proceeds for green, social, or a mixture of green and social purposes. Market practice for disclosing how the issuer intends to use the proceeds has developed over several years in line with the Green Bond Principles, the Social Bond Principles, and the Sustainability Bond Guidelines. The precise way and extent to which an issuer includes such disclosure in its bond prospectus will vary and is evolving as an increasing number of issuers are choosing to include the option to issue this type of bond under their debt issuance programs. This is an area that ICMA members continue to discuss, and we are aware that several policymakers are focusing on it closely, in particular in Europe. Similarly, the sustainability-linked bond market is developing, and market participants are focusing closely on how the terms of such bonds are drafted and included in bond prospectuses. More generally, ICMA's underwriter community has noted the importance of ensuring that any ESG-related information that could affect the credit of the issuer, i.e. its ability to repay principal and pay interest, is included in an issuer's bond prospectus, regardless of whether it relates to a sustainable product or not. This reflects the fundamental information that investors in bonds need to know before making their investment decision. In addition, where ESG information is an integral part of the issuer's principal activities, that is required to be disclosed under the EU and UK prospectus regulations. So what about other more general types of ESG information on the company? Many issuers are already subject to periodic non-financial or sustainability reporting requirements, or choose to make such disclosures voluntarily. They also often have one or more ESG ratings. Regulatory requirements in this area are set to increase, with a number of bodies, including IOSCO, the FSB, the SEC, the EU, and the FCA, all looking at this important topic. So to what extent does that periodic ESG information or sustainability-related information need to be brought in to an issuer's bond prospectus? Well, the current view of ICMA's Legal and Documentation Committee and its ESG working group is that that information does not need to be replicated in an issuer's bond prospectus unless it is relevant to the bonds to be issued. In other words, it affects the credit of the issuer, or it relates to the use of proceeds, the terms of the bonds, or the issuer's principal activities. This approach will help to ensure that bond prospectuses do not become cluttered with information that is not necessary for an investment decision in the bonds. It will also help to manage issuers' costs, and it reflects the increased liability that attaches to prospectus disclosure compared with other types of disclosure in many jurisdictions. ICMA members will continue to discuss this and related matters against a rapidly evolving backdrop of market and regulatory expectations in this area. We will also engage with policymakers as appropriate. If you have any questions on our work in this area, please do not hesitate to contact us.
I will now hand over to Rico Zhang to discuss sustainable finance developments in China.
Hello, I'm Rico Zhang from the ICMA Hong Kong office. I'm here today to give a quick update on the recent sustainable finance development in China. As you probably know, ICMA has been actively engaged with regulators in China on sustainable finance. NAFMI, the self-regulatory organization for the interbank bond market, which oversees 85% of China's domestic bond markets by volume, continues to cooperate with ICMA closely on this front. ICMA has been advising NAFMI towards adoption and convergence with the international best market practices. Regulatory progress is taking place in 3 areas. Firstly, introduce sustainability-linked bonds. Advised by ICMA, NAFMI published its Q&A on SLBs on April 28th. The Q&A stated that it is based on ICMA's SLBP, and that the SLB insurance are encouraged to comply with both the SLBP and the Q&A. The explicit inclusion of this wording, which promotes consistency, will help international investors to understand SLBs in China. The Q&A is consistent with the SLBP and provides guidance to local issuers. Additional features incorporated for local context include providing guidance on materiality of KPI, SPT, and providing 30% of issuers' revenue as a numeric reference for judging materiality, though it is not mandatory to use it. It states that the specific KPI, SPT, can be a sustainability target at the corporate level or for selected main geographical areas, or one that is related to the business that account for 30% of its revenue or more, suggesting that KPI SPT be aligned with national sustainable development strategies, requiring issuers and external reviewers to disclose their respective duties and obligations, as well as their responsibilities in case of indemnity compensation to investors. The external reviewers should pledge that they will not use any inside information for trading, stipulating some qualification requirements for external reviewers. Since then, a few onshore Chinese SLBs, following both the NAFMI Q&A as well as the SLBP, have been successfully priced, with more in the pipeline. Secondly, converge with international practices on green. NAFMI is convening the Green Bond Standard Committee, gathering various financial regulators onshore. The committee seeks to create an overreaching standard for domestic green bonds that is more aligned with international market practice, particularly the green bond principles. Thirdly, extending sustainable finance to social. Having recognized the potential and importance of social bonds, NAFMI is also consulting ICMA on its draft rules on social and sustainability bonds, extending from purely green to the wider range of sustainability. Apart from these regulatory developments, NAFMI is also working on various measures to promote sustainable finance, including showcasing top green bond investors based on the amount of green bond holdings. ICMA will continue to work with NAFMI closely on the capacity building. Thank you.
Rory Ewing and Mushtaq Kapasi will now discuss Hong Kong SFC book building consultation.
Hello, I am Mushtaq Kapasi, Managing Director and Chief Representative for Asia Pacific at ICMA.
And I'm Rory Ewing, Senior Director, Primary Markets. We will now talk about the response ICMA filed on 7 May to the recent book building consultation of the Hong Kong Securities and Futures Commission, SFC. The SFC was consulting on a proposed addition to its binding code of conduct for SFC licensed and registered persons. This related to ECM and DCM book building and placing activities.
By way of introduction, ICMA firstly emphasized the difference between bonds, DCM markets, and equity ECM markets, and the need for the code to segregate its DCM and ECM provisions. Second, ICMA expressed understanding of SFC concerns around certain Hong Kong market dynamics and support for solutions enabling Hong Kong to thrive as a venue for international DCM issuance. Third, ICMA suggested SFC might find value in reviewing the legal texts of national regulations behind IOSCO's September 2020 recommendations. And fourth, ICMA provided links to background materials we have prepared on bond syndication.
In terms of geographical scope, the response noted three things: the cross-border nature of most DCM transactions involving Hong Kong, the risk of inconsistent practices in transactions where some intermediaries are in scope and others are not, and lastly, the related risk of regulatory arbitrage arising from various aspects of the SFC's proposal. In this respect, ICMA proposed a clearer Hong Kong nexus, such as Hong Kong listed obligors, and also requested how equity-linked debt might be characterized.
In terms of syndicate roles, the response emphasized three aspects. First, substance over titles. Second, that non-syndicate roles are not recognized in current DCM practice, and that, quote, overall coordinators, or OCs, should not be responsible for advising issuers on syndicate composition and remuneration, or for the conduct of other syndicate members. Each of them should be responsible for their own conduct, as well as for their own risk position. ICMA agreed, though, with early syndicate appointment and early fixing of remuneration, namely prior to public announcement of a transaction. ICMA also noted underwriters do not have a fiduciary relationship with their issuer clients, acting rather as arm's length principles when making transaction recommendations.
The response addressed various granular questions, emphasizing 9 aspects. 1. Several considerations arise regarding rebates, uniform pricing for end investors, any intermediary fiduciary duties, and that syndicates cannot police other intermediaries. 2. Any information relating to connected investors should emanate from issuers. 3. Syndicates seek to mitigate duplicated and unusual and irregular orders. 4. Orders known to be inflated are not accepted into order books. 5. Order books should be transparent to issuers, and any book updates should be consistent, but public book updates should not be compulsory. 6. X orders should, on balance, be prohibited, and omnibus orders are not a recognized concept in current DCM practice. 7. Arm's length internal orders should be treated pari passu with external orders in terms of pricing relevance and allocations. 8. Record keeping requirements should be proportionate. And 9. A longer implementation timeline, phased implementation, and an interim review should all be considered.
Other than these points, the response emphasized 5 further aspects. First, the importance of proactive SFC supervision. Second, that underwriters undertake various services for multiple issuer clients who may be competitors in their own areas, and with internal controls to manage any potential conflicts. Also, that it may be unrealistic to expect issuer hedging needs will never impact benchmarks used in pricing. That senior management should not be required to be involved in granular transactional decisions to the extent relevant policies and procedures are fully in place, and that there should be further consultation on the legal text once the final policy aspects have been confirmed.
Relevant parts of the ICMA Primary Market Handbook are referenced throughout the response. ICMA will continue seeking to engage with the SFC as this workstream progresses. Thank you for your attention.
Our next speaker is Andy Hill, who will talk about CSDR mandatory buy-ins.
I'm Andy Hill, and I'm going to update on CSDR mandatory buy-ins. On July 1st, 2021, the European Commission published its keenly anticipated report following the targeted review of CSDR. As expected, it includes a section on settlement discipline, which notes that most respondents to the review consultation were opposed to the mandatory buy-in regime, and it recognized a significant lack of clarity as to the scope of application of the mandatory buy-in (MBI) rules. The report concludes that it is appropriate for the Commission to consider proposing certain amendments, subject to an impact assessment, to make it more proportionate and avoid potential undesired consequences. While this should be seen as positive, there still remains the issue of timing. From ICMA's discussions with the Commission, it would seem that the current plan for the Commission to put forward legislative proposals amending the NBI regime will be December 2021. Given that the current implementation timeline for the existing RTS is February 2022, this will mean that firms will need to undertake extensive contractual work and operational builds over the coming months to support implementation, and do so in the full knowledge that 1, the current NBI framework contains a number of operational flaws and legal uncertainty around scope, and 2, they will almost certainly need to repeat this work once the necessary revisions to the NBI framework have been agreed. The title of the settlement discipline section in the report is Reducing Disproportionate Burdens and Costs Related to Settlement Discipline. ICMA intends to support implementation in the international bond markets through revising its existing buying rules to provide both a contractual framework and market best practice. It will also produce a GMRA annex to cover in-scope repos, but this is now expected to be in the second round of implementation. Meanwhile, ICMA, in coordination with its members and other industry bodies, is working hard to persuade the relevant authorities that it would be far more efficient to make the necessary amendments to the NBI framework first, rather than requiring the industry to implement the regulation twice. ICMA and its members also continue to raise concerns about the expected impacts that the NBI regime will have on bond market pricing and liquidity, as well as for the competitiveness of European capital markets. Important considerations as Europe looks to rebuild its economy following the COVID pandemic.
I will now hand over to Liz Callahan to discuss the ICMA Guide to Definitions and Best Practice for Bond Pricing Distribution.
Hi, everyone. I'm Elizabeth Brooks Callahan on the secondary markets team here at ICMA. Today, I'd like to talk to you about ICMA's Industry Guide to Definitions and Best Practice for Bond Pricing Distribution. In secondary electronic bond markets for many years, the buy side has been experiencing doubt and cynicism regarding advertised bond pricing interests originating from the sell side. In some cases, the advertised interests are misleading, although in most instances, this misrepresentation is unintentional. Sell-side buying or selling interest advertisement is represented as axes in the market. The term axe stems from having an axe to grind. For example, frequently heard in bond markets is Bank X is axed on bond Y. This is the de facto market practice for pre-trade bond indication of interest. Even though axes, which are pre-trade bond pricing information, are important for traders, the way in which they are distributed is not uniform. Buy sides wanted to improve this practice in order to have less confusion and mixed messaging in the market. As a result, buy sides were the primary drivers for the resulting ICMA Industry Guide to Definitions and Best Practice for Bond Pricing Distribution. The buy side may have been the primary driver for this guide, yet the ICMA Electronic Trading Council, ETC, initiative had full cross-market support from both buy sides and sell sides, and in addition, technology providers, information bulletin boards, and trading venues were also supported this venture. Meetings were very well attended. At one meeting, the ETC subgroup had 97 ICMA members taking part. The fact that we had support and sign-off from all major trading venues and AXE bulletin boards, who all have to kick off technology change projects in order to implement this guide to best practice, reflected the importance and value of this bond pricing distribution standardization initiative. However, the process was not easy. In the beginning, there was no common understanding as to pre-trade pricing terms used in bond markets. We had to go through some good old-fashioned soul-searching in discussing what terms meant, most notably around the term two-way acts. One member even saying the term two-way acts was pure nonsense. While it took a while, the ETC members all agreed with this member firm. The term two-way acts should be replaced. The term was subsequently replaced with market run. All ETC members agreed when there is clear definition, accepted consensus market practice, pre-trade pricing indications of interest are more accurate and therefore more dependable. I encourage you to please click into the link and read the detailed industry guide to definitions and best practice for bond pricing distribution. Thanks very much.
Alex Westphal is our next speaker and will discuss repo settlement efficiency.
Hi, my name is Alex Westphal. I'm a director here at ICMA and the secretary of our European Repo and Collateral Council, and I will talk today about our work on settlement efficiency, with the primary focus on repo, but the topic is of course much broader than that. So this is something that we haven't covered before as part of these updates, but post-trade efficiency has been an important priority for the ERCC for a long time, and it is particularly close to the heart of our ERCC operations group. And of course, also an important complement to our work to prepare the industry for the upcoming implementation of CSDR settlement discipline, which we have heard about before. So certainly also very timely in that context. The work on settlement efficiency actually originated from an ERCC Ops work stream on intraday liquidity, but there has always been an important overlap between the two topics, and unsurprisingly, over the past year, the focus has increasingly shifted to those aspects that have a direct impact on settlement efficiency and where we hope to achieve some very concrete results and improvements. So it's quite a complex topic, but in a nutshell, we're now focusing specifically on three tools. First, the shaping of settlement instructions. So that is splitting up large trades into smaller shapes for settlement, which can then settle individually. There are some existing best practices for manual shaping, including in our repo guide, but shaping is currently not widely applied. So we are exploring whether this can be automated across the board, as is currently the case in the US, and also for certain parts of the market in Europe, mainly for CCP cleared repo. The second tool we're looking at is automatic partial settlement or auto-partialing, which achieves a similar result as shaping, but is applied directly at settlement level by the CSD. Auto-partialing is already available today in many settlement systems, but not yet used as much as it could be. So we're looking at the bottlenecks here and how to increase the usage. And finally, automatic securities borrowing, a service offered by many CSDs and custodians, where securities are borrowed automatically from a pool of available securities to facilitate timely settlement. So what have we done so far? First of all, the work over the past years has led to a number of concrete updates to our guide to best practice in the European repo market. So those were published back in March. So that was already a very positive step, but now we are discussing additional measures beyond those best practices, which can help make a real positive impact, we hope. In February, we held the first cross-industry workshop on settlement efficiency, which helped to narrow down the focus on the three tools that I already mentioned earlier as an immediate priority. And based on the discussions, we formulated some concrete and quite ambitious recommendations, which essentially define where we want to get to with this initiative. As a follow-up, we're now holding a series of targeted workshops to see how each of these recommendations can be implemented. We kicked this off on the 25th of May with a workshop on partial settlement. On the 2nd of July, we held a second workshop focused on shaping, and the third meeting will be set up in summer to cover auto borrowing. So far, we've had really good engagement from members. Both workshops were extremely well attended, and we also received really useful feedback to an industry survey on settlement efficiency that we had launched in support of the work. Now, as mentioned before, what we discuss here is definitely not limited to repos, so we are very keen to ensure broad cross-industry collaboration on this important topic. Internally, of course, within ICMA, but also with other industry associations. And we're also actively involved in relevant work streams coordinated by the ECB under the umbrella of the AMISECO and the CSD steering group, which is also doing some really extensive work on settlement efficiency, particularly in relation to settlement data. And this element will continue to be extremely important going forward in order to track progress. So overall, I would say there's really good momentum here and great collaboration, and I'm quite optimistic we can make a real difference over the next months. We'll of course keep you updated, but please also don't hesitate to reach out if you would like to get more closely involved or if you have any questions, of course. Thank you very much for listening.
Our last speaker today is Arthur Carabia, who will discuss lessons from COVID-19 from an investment fund perspective.
Good day, everybody. My name is Arthur Carabia. I'm a director at ICMA, and I'm here to speak today about the lesson from COVID-19 from a fund liquidity perspective and the AMIC contribution to this debate. This quarter, AMIC has issued with EFAMA a joint response to the IOSCO consultation on fund liquidity management by open-ended funds. And in our response, we highlight how the industry practices and existing regulatory provision in Europe are well aligned with the recommendation issued by IOSCO in 2018. We actually acknowledge that the positive impact of those recommendations, they have truly incentivized national supervisors to encourage and facilitate the use of liquidity management tools, which are now available in all main fund domicile centers. The response note that in the context of the COVID-19 market downturn in March-April 2020, that liquidity risk was overall well managed by investment funds domiciled in Europe. And we refer to an ESMA report which concluded that out of 174 alternative investment funds studied, none used substantial leverage nor had to suspend redemption. And out of 459 UCITS funds studied, only 6 funds suspended temporarily, and mainly due to valuation issues rather than liquidity issues. We believe that this shows that overall fund liquidity risk management is overall sound in Europe, and that the existing rules combined with the recommendations by IOSCO are sufficient, they're fit for purpose. We do have one recommendation to policymakers and to IOSCO to facilitate and to ease liquidity risk management, is to improve the access to information related to underlying investors and shares and units held by different categories of underlying investors to better appraise liability risk. We've answered to a second consultation to this overall policy debate of fund liquidity in the context of the COVID-19 crisis. The second one being on the money market fund. ESMA issued a consultation on potential reforms, and we begin in our response to highlight how money market fund actually managed to fulfill their role during the crisis. They were a source of liquidity, none had to suspend or activate gates, and that in the middle of a liquidity crisis. So we need to bear in mind that the absence of money market fund, or if money market fund had been unable to fulfill their obligations to the investors, redemption pressure would have been concentrated on other products, which could be problematic from a financial stability perspective. Overall, we believe that tightening the current rules for money market funds as envisaged during, under the consultation would have would have had no significant effect during the very short period where underlying markets were liquid. Money market fund manager had to sell underlying assets such as commercial papers and CDs to maintain their liquidity buffers, meaning that higher threshold could have meant more selling pressure on these markets. Other options studied, such as a liquidity exchange facility, we believe would compromise the viability of money market funds. Using the current buffers in a contracyclical manner in period of stress is worth exploring, but we don't think that these should be prescribed by the regulation, but decided on an exceptional and ad hoc basis by financial supervisors. We would also welcome the decoupling of regulatory thresholds from suspension gates and fees, which could indeed attenuate the first mover advantage. We believe that supervisors could clarify this with regulatory guidance rather than reviewing what we call the level 1 text, the actual regulation. I believe also that the focus should be on measures to enhance the functioning and the resiliency of underlying markets. And ICMA is proposing an extensive recommendation under a white paper soon to be released. And we refer to some of the preliminary conclusions in our response to ICMA. We will continue to monitor this important policy debate. There are developments not only at European level, but at international level with the FSB ongoing consultation, and we'll be taking a look at this as well. Thank you for listening.
That brings us to the end of this briefing. Please do contact us if you would like to get more involved in any of the topics discussed. There's further information available on the quarterly report itself and also on our website. Should you have any questions you would like to raise following this briefing, please do send them to questions@icmagroup.org. A recording of this webinar will be provided to members. Thank you again for joining us on today's member briefing.